At this time, we're going to have a disclaimers read by our legal counsel, who is Burke Coleman, Demotech's compliance officer. Burke?
Thanks, Paul. Just to kick it off with a couple of legal matters here. First, because participants on this webinar are or may be considered competitors in the insurance marketplace, we are providing an antitrust statement. So as you participate in this webinar, you acknowledge and agree to avoid any conduct that might violate or create the appearance of a violation of any applicable antitrust laws. This webinar must not be used as a means for competing companies to reach any understanding or agreement, whether express or implied, that restricts competition or in any way impairs the ability of companies to exercise independent business judgment regarding matters affecting competition. Participants must not discuss or agree upon any terms of trade or business strategy concerning products they have or may offer in the future. Such terms include, but are not limited to, prices or premiums, business volume, underwriting terms or standards, market share, customers, types of business written or avoided, coverage terms, territories, reserves, incurred but not reported claims, or profitability. It is your responsibility to be aware of antitrust regulations and antitrust compliance policies and to prevent any type of discussion that violates the same. In addition, we have a short disclaimer here. This webinar is for informational purposes only. Demotech does not make recommendations to companies at rates, and nothing in this presentation should be construed as a recommendation. We will be discussing various metrics and trends during the webinar today, but please note that when assigning and monitoring financial stability ratings, Demotech assesses a number of factors, and a financial stability rating reflects Demotech's opinion of the overall financial stability of an insurance company. And with those two items out of the way, I will introduce our speakers for today. So presenting today will be Miley Cook. Miley is a senior ratings analyst with Demotech. Miley joined Demotech in 2024, bringing over 7 years of experience as an actuary with a major carrier. She has a background in financial reporting, forecasting, pricing, and asset adequacy analysis, mostly for life insurance and annuity products. Miley is a fellow of the Society of Actuaries, a member of American Academy of Actuaries, and a chartered enterprise risk analyst, as well as a graduate of The Ohio State University with degrees in business administration and actuarial science. Her work at Demotech has included providing rating analysis support for life and health companies and improving the rating process. We also have Barry Kessler on the call. Barry is Demotech's Chief Ratings Officer. Barry joined Demotech in 1995. As Chief Ratings Officer, he directs the team, resources, and overall process of reviewing, rating, and issuing financial stability ratings. He holds the Chartered Financial Analyst designation and is a graduate of The Ohio State University with degrees in business administration and actuarial science. Under his leadership and expertise, his team has refined their financial statement assessment capabilities and processes. And with that, I will turn it over to Miley to jump into the presentation.
All right, thank you, Burke and Paul. I appreciate the warm introduction. And thanks again to everyone for joining today's webinar. As Paul touched on, we encourage you to put your questions in the chat. As a presenter, I will not be monitoring it, but Paul will see them and will share them with us at the end. If you think of anything after the conclusion of our webinar today, feel free to get in touch with me or Barry and share any questions that you have. With that, today we'll be walking through some of the major trends in the life and health insurance industries. This is the second in the series of 3 webinars that Demotech will be holding this week. I hope you tuned in to hear Bob Warren discuss the P&C industry yesterday, but if you missed it, the recording is available. Tomorrow, I encourage you to tune in to hear Doug Powell discuss the title industry. We'll begin with this webinar with a bird's eye view of the industry for the past 5 years. We'll focus on the size and capitalization of the industry and highlight some growth trends. From there, we'll move on to discuss some key financial metrics and how these have evolved since 2020. These are metrics that give a quick, imperfect view into the capitalization and risk of the different companies that make up the sector. They're simple, but often an effective way of looking at each company and the industry as a whole. And finally, we'll wrap up by discussing some emerging topics before opening up to Q&A. Most of the data you'll see today is sourced from S&P Global, which aggregates publicly available financial statement information from company filings. If a company does not file with the NAIC, we have not included that information. Okay, the first part of today's webinar, like I said, will cover the state of the industry by the numbers. We'll begin with a snapshot of the 2024 U.S. life insurance industry. As of 12/31/24, there are 709 companies filing with the NAIC on Form Life, Accident, and Health that held net assets greater than zero. Total direct premium collected by these 709 companies was 1.1 trillion, plus an additional 200 billion of assumed premium. 400 billion was then ceded to reinsurers, whether U.S. or commonly in a different jurisdiction, resulting in 800 billion of net premium. Additionally, the industry collected 400 billion in deposits for deposit type contracts like annuities certain or premiums on deposit. All in, that's about 1.2 trillion of funds flowing into the U.S. life insurance market to be held or managed by insurance companies. This has led to industry assets reaching 9.3 trillion, supporting liabilities of 8.7 trillion, resulting in a surplus of just over 500 billion, to be exact, 523 billion. If you look on the right, we have a breakdown of where the cash and invested assets lie for life insurers. General account invested assets are mostly in bonds and mortgages, although we are seeing a higher allocation to mortgages at the expense of bonds in 2024 relative to 2020. So bonds were about 70% of the industry portfolio in 2020. That's come down to 67%, and mortgages were only 12% in 2020. That's come up to 14%. Alternative assets, seen on Schedule BA of company stat financial statements, continue to be an attractive asset class and have grown from 5% of the portfolio in 2020 to 7% in 2024. The remaining assets consist of contract loans, typically on life insurance policies, stocks, derivatives, and real estate. Moving to the pie chart on the left side of our screen, we see an update to the Demotech Life Company Classification System. If you haven't seen this before, Demotech takes a deep dive into the 709 companies that comprise the industry and breaks them down into 10 categories. Size is a criteria that we look at, but it is not the only criteria. So walking through 2024, 9% of companies are fraternals. Most of these are quite small and have been around for a very long time, with the exception of Thrivent, which is a major carrier. 7% of companies we classify as reinsurers. These were identified as reinsurers either because they're commonly known as reinsurers in the industry, so think your RGAs, your SCORs, Swiss Re, but also companies that wrote significant assumed premium relative to their direct premium in 2024, and have stated that that's their company's core business. 3% of companies are classified as large nationals. While that's not a lot of companies, they do hold 56% of net assets and have considerable market share. So these are the ones that probably the average consumer knows. These companies have at least 100 billion of net assets and write a material amount of direct business in at least 45 states. 18% of companies are classified as mid-sized near nationals. Most of these companies write significant direct business, but do not have sufficient assets to qualify as large nationals. 5% of companies are classified as super regionals. These are companies that are smaller than mid-sized near nationals and typically write in fewer states. Many of these companies might concentrate in a specific region where they have historically had strong sales. 11% of companies are classified as limited new writings. These companies have very low first year or single premium sales, but they might have significant renewal business that is in runoff. 14% of companies are classified as state specialists. These are companies with greater than 90% of their direct written premium in any one state. As you can imagine, many of these companies are specialists in the state of New York, given the regulatory complexity that we see in that state. 10% of companies are classified as product specialists. These are companies with greater than 90% of their policyholder reserve in a single product. About half of these are life insurance specialists. I think that's really just the history of these companies. Rounding out the classification, 11% of companies are strategic subsidiaries and 12% of companies are regionals. Strategic subsidiaries are small companies that are members of a group of insurance companies and can serve a variety of purposes for that parent company. Regionals are generally small companies that write more than one product in multiple jurisdictions, but not nationally. The classification system has been relatively stable from 2023, with most movement we see year to year because of companies making big reinsurance moves that impact their premium or M&A activity. We will continue to monitor the industry this way and see what trends emerge as regulation, M&A, product rollouts, and reinsurance deals will all change the landscape. Switching to look at premium and deposit trends for the past 5 years, we've seen 8% annual growth in direct premium and deposits since 2020. Most of this can be attributed to the 20% annual growth rate in single premium, as annuities have grown in popularity for the last 5 years. But I do want to point out that renewal premiums provide, I'm going to call it an engine of consistent premium growth for the industry. So these are life insurance policies that have been in place for at least a year, and they just continue to pay into their policies, and that's going to continue to build momentum and growth for the industry. 2024 direct premium and deposits were $1.5 trillion, $380 billion for deposit type contracts, $250 billion for accident and health, $566 billion of annuity premium. You can see the breakdown in the middle there between the different sub-products, and $212 billion for life premium, and finally $50 billion of other life or annuity. Most of the growth from 2023 was driven by annuities, like I said, especially indexed and variable. Deposit type contracts have also grown significantly as interest rates have remained elevated. We're continuing to see growth in premium as 2025 is underway, and we'll be monitoring the continued impact of higher interest rates and market volatility that may persist through the rest of the year and typically impacts your variable life and annuity sales. Switching to the health industry, we see just under 1,300 entities have filed with the NAIC as health companies in the US. These companies have written $1.2 trillion of direct premium and have 272 million of participant enrollment. Looking at the composition of these 1,300 companies by largest products sold, about a quarter of the companies provide mostly comprehensive coverage. 17% play in the Medicaid space. 14% sell mostly dental. And a small number of companies provide majority vision, stop loss, or FEHB, which is Federal Employees Health Benefit Programs. The remaining 37% sell mostly some form of Medicare. A lot of that's going to be Medicare Advantage, but some companies do specialize in Medicare Supplement or Medicare Part D. Pivoting to the balance sheet, the industry holds just over $700 billion in assets with $374 billion of liabilities. Mostly that's reserved for unpaid claims, as you'd expect, leaving an industry surplus of $336 billion. Surplus for the industry has grown about $90 billion since 2020, growing about 8% each year. Relative to the life industry, surplus to asset levels are high as reserves for health aren't as conservative, and health insurers keep more liquidity on hand to deal with volatility in health claim cycles. For direct premium written, we've seen this grow from just over $800 billion in 2020 to $1.2 trillion in 2024. This has been a year-over-year growth rate of 9.5%. However, direct claim payments have grown at a faster clip, as you can see on the right. We've seen these grow from $673 billion in 2020 to over $1 trillion in 2024, a year-over-year growth rate of 12%. Much of the growth in both premium and claims has been in the Medicare Advantage space, as that's grown in popularity. So this situation, where claims are growing at a faster rate than premium, has put pressure on medical loss ratios, which we'll see on a later slide. Moving on to our next section, we'll discuss some of the key financial metrics we can evaluate to assess the underlying performance of insurance companies. This includes leverage, liquidity, and allocation to high-risk assets. I'll mostly focus on life insurance companies and then briefly touch on some metrics for health insurers. Okay, let's start with leverage. So leverage, specifically general account leverage, so I'm not taking into account any assets or liabilities that reside in the separate account, is the ratio of dollars in the general account per dollar of policyholder surplus. Beginning with the bar graph on your left, we see that industry weighted average leverage has been mostly steady around 10, but has increased in 2024 relative to 2023. The median company leverage, that's the middle dark blue line in the graph there, is holding steady around 4.3. To figure out why that is, we broke down leverage into 3 categories. So we looked at it by year incorporated, by our company classification system, and by majority product held. So this is not only a subset of companies, because it's companies that kind of specialize in a certain product, so greater than 75% of their reserves are allocated to that product. What does that leverage look like? By year incorporated tells a consistent story. Newer companies tend to have lower leverage. This is mostly because newer companies tend to be subsidiaries of larger parents and hold a strategic purpose and often do not take on a lot of risk. By company classification, we see larger and mid-sized companies and fraternals being the most levered. This could be for a variety of reasons. So maybe they're selling products that hold really large capital thirsty reserves. Or maybe for these larger companies, they have a large amount of diversification. Say maybe they're selling payout annuities and term life insurance that naturally offset somewhat. And so that necessitates a lower amount of surplus that they need to hold to feel comfortable with their risk. Or what's been the case for many fraternals, maybe they lack alternative financial resources to raise additional needed capital. So they've just been operating with less surplus and higher leverage. By major product, we see companies that hold a lot of what I'll call those capital thirsty products, like individual fixed annuities, that's IFA, or universal life having high leverage. Meanwhile, companies that hold mostly disability or medical products tend to have very low leverage, as their immediate cash needs can be less predictable and potentially higher than the reserves held to back those products. That's leverage. Now we're going to move on to liquidity. Liquidity is defined as dollars of cash and invested assets per dollar of general account liability. We see that the industry liquidity has been decreasing somewhat, while median liquidity has remained steady at around 1.15. This likely reflects the impact of very large block reinsurance deals that have occurred in the last few years, as well as a boom in the sales of IFA, so individual fixed annuities that are really capital thirsty. Looking at liquidity by major product, we see that IFA companies have the lowest liquidity at 1.07, while disability, medical, and term companies have much higher liquidity. This reflects that claims can be more volatile, increasing your liquidity needs, as well as the high capital requirements of IFA. Year incorporated and company classification tell a similar story that we saw with leverage. Our final key financial metric for life insurers is high-risk assets. So in analyzing asset composition, it's common to look at how many high-risk assets a company has. So for us, percentage of assets high risk is defined as the ratio of below investment grade bonds, you might have heard these called big bonds, stocks, real estate, and alternative investments as a proportion of the company's total net admitted assets. For the industry, this has been trending downward. Looking into the data, this appears to be because a lot of companies are reducing their their below investment grade bond exposure. But if you look at this metric by company or even company classification, it can be tricky because many companies have stock investments in affiliates that we might view differently than public security trading. By product, long-term care and IFA insurers tend to have higher high-risk assets due to longer time horizons or a desire to increase yield, while medical insurers have significantly lower high-risk assets. Kind of makes sense. Their horizon of how long it's going to take for them to return that money is typically a lot lower for those products. Of course, this is a simplified metric, and it's important to look at what specific types of assets a company is investing in to ensure they're appropriate given the company's liability profile. For example, a company might be heavily involved with mortgages, heavily indexed towards mortgages, and we want to see that their duration and riskiness level makes sense given the liability profile, even if mortgages aren't normally considered high risk and wouldn't be in this metric. Switching to take a look at health filers, leverage is much lower for health insurance companies than life companies, as you'd expect given the different risk profiles. It has remained relatively steady, but it is increasing slightly in the past couple of years. Looking at health liquidity, we see that the industry has decreased pretty significantly in 2024, dropping from 1.01 in 2022 to all the way down to 0.91 in 2024. This is an interesting watch item for the industry. Digging in from 2023, assets have been flat for the industry, but total liabilities grew 8%. Looking at a longer time horizon, so since 2020, liabilities have grown at twice the pace of assets. So this is an item to watch and tracks with medical loss ratios worsening over the last 4 years, which you can see on your right. They're peaking at 89% in 2024. The key story here is profitability will continue to be a concern for the health insurance industry as utilization and medical costs have increased. Now that we've walked through some industry trends and key financial metrics, we'd like to discuss some emerging topics that we've seen developed in the past 5 years. Our first topic is the increasing number of blockbuster, I'm going to call them mega large, block reinsurance deals, often with private equity-backed reinsurers. So in general, reinsurance is a powerful tool to manage risk, especially mortality, and to optimize the financing of high reserves that tie up a lot of capital. Companies can and have considered using affiliated companies, unaffiliated companies, and certain offshore or otherwise certified reinsurers to enter into agreements to shift partial or entire blocks of business away from their balance sheet. When they do this, they record with the NAIC in their annual statement the reserve credit they receive from these arrangements, or if they've entered into a modified co-insurance arrangement, aka ModCo, what the value of that reserve is. So looking at the sum of these values for 2020 through 2024, the industry has experienced 10% year-over-year growth in reinsurance usage. Some of this growth is attributed to higher use of affiliated entities like captives or subsidiaries, but much of the growth can be attributed to unaffiliated companies, either in the US or in reciprocal jurisdictions. Collateralized unauthorized reinsurance has also grown, as you can see in the graph on the right. Many of these large blockbuster transactions have been to reinsurers that are backed by private equity and therefore may have access to different types of investments. I listed off some notable transactions. So we see these all made the headlines. So $28 billion from Lincoln National to Fortitude Re, $19 billion from MetLife to Global Atlantic, and $11 billion from Prudential to Wilton Re. So what products are typically being seeded? You want to think about what is typically pretty capital intensive or kind of reserve thirsty. So we see a lot of individual fixed and indexed annuities, IFA and FIA, as they're also called, variable annuities with guarantees, and ULSG or universal life with secondary guarantees. These products can all have significant reserve drag, or they can introduce earnings volatility that can make it advantageous to consider reinsurance transfers, especially for publicly traded companies that have to worry about volatility in their earnings a little more than mutuals do. The popularity of large reinsurance transactions has prompted regulators and rating agencies to think about how these are analyzed. So are there concerns that some of these transactions have ultimately allowed riskier, less liquid assets to back the underlying liabilities? More eyes have been drawn to this issue in recent years. I can tell you that regulators are thinking about this constantly. It will continue to be a watch item in coming years, although the rate of ceded reserve credit growth did slow in 2024. So look at the bar graph. The jump from 22 to 23 was a lot bigger than 23 to 24. The reason for this is that there just weren't as many of those mega deals as there were in 2023. The next emerging topic we'll be covering is the rise in fixed annuity sales amid higher interest rates in the past few years. So IFA, or individual fixed annuity, is a deferred annuity that pays a guaranteed rate of interest over the contract's term. As you can imagine, rising interest rates make this product more attractive, both from the producer side and from the consumer side, as companies are able to offer higher guaranteed rates to policyholders while still earning a healthy interest rate spread. Conversely, low interest rates make this product very unattractive. Insurers can't get their spread, and the rates being offered to policyholders just really doesn't make it attractive. In fact, this product hit pretty rock bottom sales through the 2010s, while interest rates were historically very low. However, we've seen that sales have increased substantially post-COVID as rates have come up to recent highs. So the graph on the right side of your screen shows IFA net premium relative to the average 5-year US Treasury rate for that year. Generally, sales of the product have correlated with these rates. So if you look at that graph, it's pretty simple to see. And it's not just coming from a handful of players. So there's been a 12% growth in the number of companies that have IFA net premium of at least 10 million at 2024 relative to 2020. So more companies are coming off the sidelines and jumping into the game of selling IFA. With rates more or less forecasted to remain near their current levels, 2025 will likely be another year of high IFA sales. Also, in general, consumers favor safe investment products when we're amid periods of economic uncertainty, which could also help with sales. Sometimes that's called like a flight to quality. Like we did see high IFA sales right before the Great Recession started. However, if rates fall this year, which they could, no one really knows what's going to happen, we could see these sales begin to decline. So companies need to be prepared to pivot depending on which way the interest rate winds blow. Our final topic to discuss is longevity risk. Now, most companies have a feel for their mortality risk, so they kind of know how expensive missing on mortality is in a given period. However, I think it's just as serious for some companies that they're probably taking on a lot of longevity risk and they might not know how expensive that could be. So what's your risk of policyholders living longer than expected? This has a negative financial impact for any company that has products like pension plans, payout annuities, or variable annuities with living benefit guarantees, where the insurance company has to pay out more if the policyholder lives longer than expected. Pricing models typically assume a level of mortality improvement in projections, but is this assumption sufficient? So to put this in perspective, if you look at the graph on the left side of the screen, we have pooled the probability of a 60-year-old making it to 100 years old in 1980 relative to 2019, according to a Society of Actuaries study. The probability is roughly triple, from about 0.5% in 1980 to 1.8% in 2019. So when certain life and annuity products are commonly sold to new retirees in their 60s, this can have a substantial impact on pricing that is not felt for many years. So who's to say what the probability will be in 2040 and beyond? I don't know. To mitigate this risk, companies do have certain options. They can consider reinsurance, whether this means reinsuring blocks of business or engaging in longevity swaps or other products. Companies can also consider their product portfolio in diversifying with more mortality risk, so sell more life insurance offering death benefit protection that kind of acts as a natural hedge. It's not perfect, but it does provide some relief there. And of course, pricing discipline is the most important mitigation strategy for pretty much any financial risk. I heard it described similar to the foundation of your house. It's something that you should get right the first time because it's hard to fix later on. So what can the company do to make sure its pricing assumptions today are adequately conservative to protect against downside risk for longevity? Finally, we stress that companies need to continuously monitor their longevity risk and have a handle for how much risk they're taking. This is particularly important as longevity risk isn't something that you'll see the financial impact for until many years down the road. So with that, I'll thank everyone for attending and hope that you enjoyed today's session. I'll open up and see if there's any questions in the chat. As a reminder, we encourage you to watch the recording of yesterday's P&C webinar if you missed it, and hope you can make tomorrow's session on the title insurance industry. Paul, have we seen any questions come through?
We do have a couple. One from earlier. What do you think COVID's lasting impact will be on the life and health industries?
Oh, that's a loaded question. I'll start with the life insurance industry. So what we're mostly seeing on the mortality side is that COVID did elevate death claims mostly for group life insurance. Individual life insurance saw a negative impact, but it wasn't as big because the underlying population that buys individual life policies tends to be less susceptible to severe COVID that could lead to death. From what I've seen in 2024, elevated mortality across the board has mostly calmed down and returned to a more predictable level, but we'll see as new strains emerge. However, there are ancillary impacts of COVID that we're still seeing an impact on that impacts the financial results and pricing today. So changes spurred by COVID and our response led to inflation, which put pressure on expenses for life insurers, and higher interest rates as a result of that inflation have really transformed the industry. So higher interest rates have led to a huge shift in the market, and the industry is still figuring it out. So for me as an actuary, I kind of had whiplash. So as an industry, we went from being asked if our actuarial pricing models could handle negative interest rates because they just kept going down, to all of a sudden being asked, okay, well, interest rates are spiking. Are your lapse formulas making sense for like your fixed annuities? Is your lapse assumption reasonable given that rates could spike up even more? Now for the health insurance side, I think we are seeing increased claims and utilization in part because of structural and government changes, but it's also become clear that COVID has had some impact on people's long-term health that doctors are still trying to get their hands around. We saw in this presentation that profitability is being pressured on the health insurance side, and who's to say how much of that is as a result of COVID, but I think we are seeing an impact. Of course, inflation didn't help health insurance either. They're having expense problems as well. It'll be interesting to see what happens as medical innovation, more government changes, all that stuff plays through.
Thank you. That was well thought out. Well, we just had a new question come in. Is there a way to track, in general, how much various fraud schemes are impacting the industry, and if one sees a trend in that?
Yeah. I will say that most of the large life insurers have fraud divisions. I know a huge problem with fraud is continual elder abuse and account takeovers and stuff like that. On the actuarial pricing side, worrying about future products and not just maintaining what we have today, there's always concern about fraud on life insurance applications. So customers, when they fill out their applications, they're testing that they do not have any undisclosed major health problems. And sometimes that's not always truthful, especially think about smoking. Maybe you lie and say that you never smoke, but you smoke every time you drink or stuff like that. So there's a lot of effort that's going into how can we make sure that people are filling out these applications honestly and to the best of their knowledge. So there's, with the advent of more automated or fluidless underwriting, there's thought into, well, what other data sources can we pull from without having to actually ask the potential policyholder? Even some companies are trying to figure out, like, can you look at someone's voice or face and use AI to tell if they are potentially a smoker? There's a lot of creativity going on, and there has been for the last, 10 years at this point. And I think it will continue, and AI models will continue to make that even better. But as far as tracking, I do think individual companies work to try to figure out what fraud exists within their company and what they can do to stop that.
Thank you, Miley. One final one came in on longevity risk. Can you expand more on the possible negative financial impacts of longevity risk?
Sure. So I guess we're already on this slide. So I mentioned that the negative impacts will be mostly felt for pension plans, payout annuities, and variable annuities with living benefits. Probably missing from that list is group annuities written to cover pension risk transfer. So that's kind of similar risk to pension plans. Payout annuities and pension plans can be particularly worrisome because for the most part, you set one price at issue and you have to hope that's enough. You don't have a lot of levers you can pull. These pricing horizons can be very long. Say some might be 40 or 50 years. Well, you can't buy assets long enough at issue to cover that horizon. So these products take on a lot of reinvestment risk. And then if you couple that with longevity risk, where policyholders are living longer than expected, you're taking on even more risk that rates could just collapse 30 years from now when your bond matures and you have to buy a new one. Also, you're making more payments to the policyholder than originally intended, which puts pressure on the profitability of the product, as you'd expect. Let's say you're making monthly pension payments to the policyholder. If they live an extra 20 years, that's really financially hard to deal with. Variable annuities with living benefits are a similar story, but if the market performance is positive over the life of the policyholder, there might not be too much downside risk to a policyholder living longer, depending on what type of guarantee they have. However, if the market has performed poorly and the policyholder lives longer than expected, you could kind of be set up to have this double whammy of a profitability issue where they don't have much account value and you have to pay out even more for a longer period of time, even if their account value goes to zero because of that living benefit guarantee. For the most part, companies that write variable annuities with guarantees are trying to hedge this economic risk so that longevity risk doesn't further compound it. But these hedges can be expensive and eat further into the returns. You couple all this with the issue that management personnel making these pricing and product management decisions about these products, they normally won't be around to see the consequences of their actions. Like, they're making these decisions today, they're going to retire in 20 years, and this is going to hit the fan in 30 years. So you kind of have a recipe for people to care more about sales and profitability and kick that can down the road. That's where I kind of stress that you need to be continually monitoring it and shaping management's decisions and their incentives accordingly.
All right, thank you. I'd like to thank Miley for the presentation. If there are no more questions at this time, we will conclude. However, if you think of a question or want to follow up further with Miley, you can reach out through our website and get in contact with her. I'm sure she'd be happy to go offline and converse about what you're interested in.
Absolutely.
We will be mailing out a copy of her slides as well as a link to the webinar if you want to share it or just watch a review. What you see, that email will probably go out tomorrow to all registrants. I know some couldn't actually make the live broadcast, but at this time we will conclude the broadcast and thank everyone for their attendance. Have a good day.